Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. We are firing on all cylinders today because the market has served us up a situation that is practically demanding our attention. It is rare, it is messy, and it is absolutely fascinating.
It is good to be back. And frankly, looking at the ticker tape this week, we couldn't have picked a more volatile and, dare I say, controversial name to discuss.
I mean, it feels like the market is just screaming at us, doesn't it?
It really does. It's impossible to ignore.
Absolutely. So today we're breaking down one of the most interesting companies on the market, the global IT research and advisory giant, Gartner Inc., ticker symbol IT. And we have to address the elephant in the room immediately.
The elephant is more like a stampede at this point.
Right. Gartner has experienced a massive recent dislocation. The stock is down 29% in just the last week.
Just unbelievable.
On the surface, this looks like a classic falling knife scenario. It's driven by this pervasive fear that AI is going to completely replace IT advisory. So the question for us as long-term investors is this. Is this the Kodak moment where a legacy moat just evaporates because of AI? Or is the market handing us a Tier 1 Cannibal at a valuation that effectively prices in zero growth? That is the billion-dollar question we are here to answer today.
That's a huge topic.
Yep.
And the stakes are incredibly high because this isn't just about one company. It's really about the future of human advice in an artificial intelligence world. Before we dive deep, though, a quick heads up for the audience.
Right. If you're looking to invest, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time. It really helps us out.
And while you're there, please like, subscribe, and let us know your questions in the comments. We do read them.
Now let's get into it. Pillar number 1, the anatomy of the crash and the business engine.
Okay, let's start with what you called the blood in the streets moment. We need to set the scene for the listener. Gartner is currently trading at approximately $157 a share.
Give or take a few cents, yeah.
That puts the market cap at around $11.2 billion.
And to put that in context, this is a stock that was trading significantly higher. I mean, we're not talking about a small dip here. This is a massive drawdown from its 52-week highs. What we're seeing is a complete and total repricing of the asset.
The market has just taken a look at Gartner and decided, nope, you're worth 30% less today than you were last Tuesday.
That's it. A fundamental reevaluation of the entire thesis.
And when you look at the valuation metrics post-crash, it starts to look, well, it starts to look like deep value. I mean, genuinely cheap.
It does. Let's just run through the multiples because they're pretty startling. It is trading at roughly 12.8 times trailing 12-month earnings.
12.8.
Now, for those who don't follow this stock closely, you need to understand Gartner has historically traded at a significant premium. We're talking 30, sometimes even 40 times earnings or more. It's always been treated as a compounder, a really high-quality business.
So we are seeing a multiple compression of over 50%. That's just staggering.
It's a collapse.
12 times earnings is what you pay for a bank or a utility, not a tech services monopoly. But the number that really jumps out at me, and I know this is the one you love, is the free cash flow yield.
Yes, this is the truth metric, isn't it? It cuts through all the accounting noise. The free cash flow yield is sitting at a massive 11%.
11%.
And the enterprise value to free cash flow is around 9.5 times.
Okay, let's pause right there for a second. Can you explain to the listener why an 11% FCF yield is such a big deal? Why does that make our ears perk up?
Sure. Think of the yield as the cash return you would get if you bought the entire company today, lock, stock, and barrel, and just put the profits in your pocket. So if you buy a government bond, you might get 4%, maybe 5% if you're lucky.
Right, the risk-free rate.
Exactly. If you buy the S&P 500, the free cash flow yield is usually around 3% or 4%. So finding a high-quality business yielding 11% in cash is incredibly rare. Usually, if a stock yields that much, it's a distressed oil company, a dying retailer, or a company that's genuinely on the verge of bankruptcy.
Right. It usually means the market thinks that cash flow is about to disappear entirely.
Exactly. It is priced for disaster. Total disaster.
So I have to play the skeptic here. The market is generally efficient. It's not usually stupid. Why the crash?
Right.
Is this just a bad quarter? Did they miss earnings by a penny? Because usually if something is trading at 9.5 times cash flow, there is a fire somewhere, a big one.
There is a fire, but it is primarily a fire of perception and narrative. This isn't just about missing a quarterly number, although, to be fair, the guidance was weak. This is structural fear. The market has adopted a new belief system, a new story,
And that story is.
that large language models, LLMs, will completely displace the need for human IT advisory.
The idea that ChatGPT is the new Gartner analyst.
Precisely. Why would you pay hundreds of thousands of dollars for a subscription when you can just ask Claude or Gemini? And the recent guidance from management, it just poured gasoline on that fire. They guided for a muted recovery for 2026.
Muted recovery, two words that can destroy billions in market value.
In Wall Street speak, muted is a terrifying word. It's code. The bears looked at that guidance and they said, aha, I knew it. This isn't cyclical. This is secular.
This is the beginning of the end.
Exactly. The AI disruption is starting. This is it. This is a Kodak moment.
So the market sees muted recovery and translates it to terminal decline. They are pricing it as if the business is going to shrink forever.
That is precisely what's happening. They are pricing it as a melting ice cube.
Okay, so to understand if they are right, we have to actually deconstruct the black box here, because I think there is a massive misunderstanding of what Gartner actually sells. If you ask the average person on the street or even the average investor, they might say, oh, Gartner, they sell reports. They sell PDFs about cloud computing.
And if you think Gartner sells reports, you fundamentally do not understand the business. It's complete misreading of the value proposition. That is like saying a doctor sells prescriptions.
Right. The prescription is the deliverable, but the value is the diagnosis.
Exactly. The value is the trust, the expertise. Gartner doesn't sell information. Information is cheap. In fact, information is free. You can get all the information you want on Google. Gartner sells certainty.
Certainty. Unpack that for us. Certainty to whom?
Certainty to anxious chief information officers, CIOs. You have to empathize with the customer here. Think about the psychological state of a CIO at a Fortune 500 company. What does their life look like?
Yeah. Okay, I'm a CIO. I've got a $500 million budget. The CEO is on my back.
You are under immense pressure, constant pressure. You have to modernize the entire tech stack. You have to move everything to the cloud. You have to secure the network against nation-state hackers. And now you have the board screaming at you to do something with AI.
And if I make a mistake?
If you make one mistake, if you pick the wrong vendor, if the implementation fails, if you get hacked, you are fired. Your career is over.
The stakes are incredibly high. It's a career risk decision.
They are personal stakes.
Yeah.
Gartner sells the certainty that you are making the right decision, or at the very, very least, a defensible one. It is career insurance.
Ah, I see. So when I pay that subscription fee, I'm not buying data. I'm buying a shield.
You are buying a shield. And the unit economics of selling that shield are, well, they're beautiful. They're just phenomenal.
Let's talk about that money flow. How does the cash actually move through this business?
So the core transaction is a recurring research subscription. It's a SaaS model, essentially. That's the bedrock. Then you have high-margin events. Their conferences are huge profit centers and a smaller consulting arm. But the secret sauce, the thing that makes the CFO smile every morning, is the negative working capital.
I love this concept. But negative usually sounds bad. Why is negative working capital the holy grail here?
It's a completely counterintuitive term, I know. In most businesses, let's say a car manufacturer or a retail store, you have positive working capital needs. You have to buy steel, build the car, ship the car to the dealer, and then you wait for someone to buy it. You spend cash, months, maybe even a year, before you get cash back from the customer.
You're out of pocket. You have to fund the inventory, fund the whole process.
Right. Gartner is the complete opposite. Clients pay up front. If you want a subscription for 2026, you write the check in January of 2026, or more likely in December of 2025.
So Gartner is holding the cash before they even deliver the service.
Correct. They get the money on day 1. They use that money to pay the analyst's salary on day 15, day 30, day 45. It is effectively an interest-free loan from their entire customer base that grows as the company grows.
Which allows them to have massive liquidity without taking on debt.
It funds their operations and, crucially for our thesis later, it funds their buybacks. It's a self-funding machine.
That is a phenomenal engine. But that engine only works if the customers keep coming back, right? It all depends on pricing power.
It does. And historically, they have raised prices 3% or 5% annually, like clockwork. They have been an inflation hedge.
And that's the current test, isn't it? That's the whole debate in a nutshell.
That is the battleground. Can they maintain that 3 to 5% increase when AI offers good enough advice for free? The bears say absolutely not. The bears say pricing power will collapse because the alternative is now zero cost.
Which transitions us perfectly to pillar number 2. the Moat assessment. Is this business a fortress, or is it a mirage that's about to vanish in the desert?
We have to assess the durability of this business strictly. We need to look at the psychological and the structural barriers to entry. And the primary moat here isn't technology. It isn't data, not really. It's a psychology term. Effective valence.
Okay, hold on. Effective valence. You're dropping psychology terms on us now. Break that down for me.
It just refers to the emotional value or the charge attached to a brand, the feeling it gives you. In the corporate world, we call it the nobody gets fired effect.
I've heard this. The old saying was, nobody gets fired for buying IBM. Now it's nobody gets fired for listening to Gartner.
Exactly that. Let's go back to our anxious CIO. Imagine you are spending $10 million on a new ERP system from SAP or Oracle. That is a massive risk. Your job is on the line.
Absolutely.
If you use the Gartner Magic Quadrant to select the vendor, you pick the one in the top right corner, the leader, you have a liability shield.
You have a paper trail.
Yeah.
You have CYA, cover your assets.
You have a scapegoat. If the project fails, you can stand in front of the board of directors and say, look, I followed the gold standard recommendation. I chose the industry leader as verified by the world's foremost authority, Gartner. The board accepts that. They nod.
Now contrast that with the AI scenario. What does that meeting look like?
Imagine you go to the board and say, well, the $10 million project failed, but I asked ChatGPT and it said this software was cool.
You're fired immediately, no question.
You are laughed out of the room. An AI chatbot cannot provide that liability shield. It has no reputation to lend you. It has no skin in the game. It can't be held accountable. That is the effective valence. Gartner transfers its reputation to you. AI cannot do that.
That makes perfect sense. It's about liability and institutional trust, not just raw data or an answer.
And this creates what Charlie Munger would call a Lollapalooza effect.
A Munger favorite, the confluence of factors.
Yes. It's when multiple biases or forces converge to drive a massive, powerful outcome. In Gartner's case, it is a two-sided network effect. Think about the software vendors, Salesforce, Microsoft, Oracle, all of them. They must participate in the Magic Quadrant. It's not optional.
Why? Why can't they just say no?
Because if you are a software vendor and you aren't on that quadrant, you basically don't exist in the eyes of the enterprise buyer. You are invisible. So vendors are forced to give Gartner their data, they're forced to sponsor their events, they're forced to brief their analysts. And on the other side, buyers must use Gartner to validate their choices because of that liability shield we just talked about.
It's a feedback loop. One side feeds the other.
It forces the entire industry to pay the toll to Gartner. It's a very, very powerful position to be in. It's not just a service. It's a market structure that they control.
But I have to challenge you on the data advantage. The bulls always talk about the cornered resource. They say, Gartner has better data. But can't AI just scrape the web? Honestly, if I ask Perplexity or Google Gemini for a comparison of CRM software, it gives me a pretty good table. It's 80% of the way there.
It is 80% of the way there on public information. And this is the critical distinction that the market seems to be missing. AI models, even the best ones, the GPT-5s of the future, are trained on the open internet. Public filings, marketing brochures, news articles, Reddit threads.
Which is a lot of data, to be fair.
It is a lot of noise.
Yeah.
It's what companies want you to see. Gartner owns proprietary data. They conduct thousands of inquiry calls with clients every single year. These are confidential one-on-one conversations where a CIO from, say, Coca-Cola tells the Gartner analyst, hey, this new software from vendor X is crashing all the time, the customer support is terrible, and by the way, the implementation costs double what they said it would.
That kind of stuff is definitely not on the internet.
No, that is behind a non-disclosure agreement. That's the real dirt. So Gartner knows what companies are actually doing, what's actually working, not just what the vendors say in their glossy press releases. They have the ground truth. AI has the map. Gartner knows the terrain, the potholes, and all.
However, we have to be honest. We have to look at the other side. There is an anti-moat here. There is a real disruption risk. We can't just ignore the bear case.
Absolutely not. And we'd call this counter-positioning. It's a classic disruption theory concept. If an AI agent provides 80% of the value of a Gartner analyst for 0% of the cost, who churns? Who leaves the platform?
We're little guys, the ones who can't afford the big subscription anyway.
The SMB segment, small and medium businesses, exactly. If you are a small business owner, say you run a chain of 5 bakeries and you need new email software, you don't have a board of directors, you don't need a liability shield, you just need an answer.
So you ask the AI, it takes 10 seconds, it's free. Good enough.
Exactly. So the moat is absolutely narrowing at the bottom of the market. Informational queries, basic how-to questions, simple vendor lists, that is becoming a commodity. Gartner will likely lose a lot of that business over time.
But the bull thesis is that the moat remains wide at the top. The high end is secure.
Correct. The strategic execution questions. How do I reorganize my entire IT department for the AI era? How do I negotiate a $50 million contract with Amazon Web Services? That is high stakes, nuanced, human work. The top of the pyramid is safe, we think, but the bottom is definitely eroding.
Okay, so the business might lose the low-end customers, but they keep the whales. That's the theory. Let's move to pillar number 3, the Cannibal thesis. This is where the financials get really interesting for me and where the math starts to look incredibly compelling for the shareholder, regardless of growth.
This is the financial resilience part of the equation. This is why you sleep well at night, even with all the AI fear.
So let's look at the quality of earnings first. Is the profitability holding up amidst all this chaos? Are the margins okay?
Operating margins are still very healthy, generally north of 18 to 20%. This is a high-margin, asset-light business.
What about stock-based compensation, SBC? That's always the hidden killer in tech companies. Are they just diluting us to pay their staff?
It exists, certainly. They use equity to retain talent, which is standard practice in the industry. But here is the reality check. With an 11% free cash flow yield, the raw cash generation covers that dilution multiple times over.
So they are printing enough cash to offset the new shares they give to employees and still have a mountain of cash left over to do other things.
Easily. And because of that negative working capital cycle we discussed, their free cash flow to net income conversion is typically over 100%.
Meaning they actually generate more real cash for the business than their accounting profits on the income statement would show.
Exactly. Accounting is an opinion, cash is a fact, and the facts here are very strong.
Now, let's define the Tier 1 Cannibal, because this is the core of the bull case if you're buying at these prices. I love the term cannibal in finance. It sounds so aggressive.
It comes from the wonderful book The Outsiders. A cannibal is a company that aggressively, voraciously eats its own shares. It takes its cash flow and uses it to buy back stock on the open market, constantly reducing the share count. This increases the percentage ownership of every remaining shareholder without them spending a single penny.
And Gartner has a serious track record here. They aren't new to this game.
A phenomenal track record. They have reduced the share count from about 89 million shares in 2021 to roughly 71 million today.
Wow. So they've retired, what is that, 18 million shares?
That is nearly 20% of the entire company retired in just a few years.
That is a significant chunk of the company gone. And here is where the crash gets really interesting. Explain the math of the buyback when the stock price falls. Why is a lower stock price actually a gift for the long-term holder in this situation?
This is the part that feels completely counterintuitive to most people. We're trained to want the stock to go up. But if you are a net buyer of stock, which the company is on your behalf, you want the price to be down. You want it to be cheap.
It's like buying hamburger meat. You want it to be on sale.
It's the exact same principle. Management is buying back stock using that juicy 11% free cash flow yield. Buying their own stock at $157, which is roughly 13 times earnings, is infinitely more accretive than buying it at $450 or 35 times earnings.
You get so much more bang for your buck.
You retire dramatically more shares for every dollar spent. We call this the super cannibal window. If they use 100% of their free cash flow to retire stock at these depressed prices, they could retire about 7 to 8% of the float. Annually?
8% of the company gone in 1 year, just from the cash flow.
Yes. If the stock stays this cheap for 3 years, they could theoretically retire nearly a quarter of the entire company.
That leads to the zero growth compounding argument. This is my favorite part because it takes all the pressure off the business performance. It's a different way to win.
It completely de-risks the investment from a growth perspective. Walk through the math with me. Imagine a scenario where Gartner's revenue stays completely flat, 0% growth. They sell the exact same amount of subscriptions in 2030 as they do today. Net income stays flat, 0% growth.
That sounds like a terrible investment, a stagnant company, a dead stock.
It sounds terrible. But if they're buying back 8% of the shares every single year, the earnings per share, the EPS number that actually drives the stock price, will grow at an 8 to 9% compound annual growth rate.
Because the denominator, the number of shares, is shrinking every year.
The pie stays the same size, but your slice of the pie gets bigger every single year. So the stock price should theoretically go up 8 to 9% a year just to keep the PE ratio flat.
So you don't need business growth to win here. You just need durability. You just need the business not to die.
Correct. If the business doesn't implode, the simple math of the buybacks forces the EPS up. You are leveraging the balance sheet to generate shareholder returns.
That is a powerful, powerful safety net. But we have to look to the future. We can't just drive looking in the rearview mirror. So let's go to pillar number 4, the 2030 horizon. We've mapped out 3 divergent scenarios for how this plays out.
We have. And when you analyze a dislocation like this, you have to think in probabilities, not certainties. You have to weigh the different paths.
Okay, let's start with scenario A, the tobacco model. This is our base case.
Think about the tobacco industry over the last 20 years. Everyone knows smoking is bad. The volume of cigarettes sold declines every year. Regulations are tight. It's a dying industry by every definition.
But Altria and Philip Morris have been incredible stocks to own.
Because they have insane pricing power, and they just print cash. They raise prices on their addicted customers faster than the volume declines. In this scenario for Gartner, AI hurts the low end. The SMBs leave, as we discuss. But enterprise complexity keeps retention stable with the big customers. Gartner becomes a low-growth utility, maybe 3 to 5% growth per year.
But with very high cash flow.
Massive, predictable cash flow. The returns are driven almost entirely by the yield and the buybacks. In this world, the valuation multiple compresses permanently. It doesn't go back to 30 times earnings. It stays in this 12 to 15 times range.
And the price target in that scenario?
By 2030, driven by the buybacks and that modest growth, you're looking at a price of roughly $280 to $310.
So a solid double from here, effectively, over the next 4 or 5 years.
Yes, a solid, kind of boring double-digit return. You won't get rich overnight, but you're very unlikely to lose money.
Okay, now, scenario B, the Kodak fade. This is the bear case. This is the nightmare.
This is what the market is afraid of right now. This is the narrative that's been priced in. The story here is that large language models successfully replicate the Magic Quadrant methodology entirely. Not just the data, but the judgment, the trust.
CIOs decide they actually trust the AI agents more than the human analysts.
The trust evaporates. The nobody gets fired effect flips on its head. Suddenly you look like a dinosaur if you're still paying for Gartner. Retention drops to 80% and then starts to spiral down from there. The high fixed costs of their analyst base eat the margins. It becomes a true value trap.
The multiple collapses even further.
It trades at 5 to 8 times earnings like a dying newspaper.
And the price in that world.
You're looking at 120 to 140, or potentially lower. You lose money, even with the buybacks. It's a melting ice cube that melts faster than they can shrink the share count.
Okay, that's the risk. We've defined it. Now give us the hope. Scenario C, the trusted arbiter. This is the bull case.
This is the most fascinating one to me and the most contrarian. The narrative here is that AI creates a verify crisis, a crisis of trust.
Too much noise, a tsunami of bullshit, if I can quote some tech commentators.
Exactly that. The world is flooded with synthetic content, deepfakes, hallucinated advice from LLMs, and SEO spam generated by bots. In that world, truth becomes the single most expensive commodity. Human verification becomes a premium product.
The human in the loop becomes more valuable, not less.
Yes. CIOs are drowning in noise. They don't know what is real. They need a trusted arbiter, a human source of ground truth, more than ever. Gartner actually raises prices because they are the only insured source of truth in a world of digital lies.
So in this scenario, they actually grow faster because of AI.
They return to double-digit growth. The market realizes AI is actually a tailwind for confusion, which is a tailwind for the advisory business. The stock re-rates back to a quality compounder status, 25, maybe 30 times earnings.
And in the price target there.
You get the earnings growth plus the multiple expansion. You were looking at $550 plus, a true home run.
So we have a potential range from $120 to over $550. That is a massive spread.
That is the spread. But here is the kicker, and this is the most important part of the valuation argument. At $157, the market has basically priced in the tobacco scenario, or even parts of the Kodak scenario already. You are paying a terminal decline price for a business that is still printing cash.
Because the downside is, to some extent, already baked in.
And you're getting the bull case scenario C, the trusted arbiter, as a completely free option. If the world gets messy and people crave truth, you get all of that upside for free at today's price.
There is one more twist in the capital allocation story that we need to touch on before we wrap up. The dividend pivot.
Right now, Gartner pays 0 dividends, and they absolutely shouldn't. Buybacks are mathematically superior when the stock is this cheap.
But that could change if the stock just stays cheap forever.
If the stock stays depressed for a few years, say until 2028, and the market simply refuses to give them a higher multiple, look for a transition in strategy. If management finally admits, okay, the market sees us as an ex-growth company, we are a mature utility, they could switch from being a buyback cannibal to a dividend aristocrat.
What kind of yield could they pay if they did that?
With their current cash flow, if they just stopped buybacks today and paid it all out as a dividend, they could theoretically pay a 10% dividend yield.
A 10% yield. That would put a hard floor under the stock price. Income investors would flock to it.
It would immediately become a bond proxy. You would stop the slide. So there's an exit strategy for the capital allocation that provides downside protection.
So let's wrap this all up with the outro, the final sleep well assessment. How fragile is this thesis?
I'd say the fragility is medium. It is asset light, which is robust. There are no factories to close down. But it is intellectually fragile to AI. You have to watch the technology adoption rates and customer retention numbers very closely.
The wager. What's the core bet you're making?
The investor is fundamentally betting that human trust will remain more valuable than AI efficiency for high-stakes, career-ending decisions.
And the valuation verdict.
At 157, the buy zone is wide open. We would peg the fat pitch zone as being between 150 and 175. This is where the margin of safety is highest.
Before we sign off, I want to leave the listener with one final provocative thought. We've talked about AI as the big external risk, but I think there is a bigger internal risk, a human risk.
Go on.
What if the biggest risk isn't ChatGPT? What if it's management hubris?
Ah, the diversification risk, a Peter Lynch classic.
Exactly. The danger here isn't just that the stock falls. The danger is that Gartner's management looks at their falling stock price, they panic, and they decide they need to chase growth to change the narrative.
They want to get the stock price back up.
So they take all that beautiful, wonderful free cash flow that should be going to accretive buybacks, and they go out and buy a generic AI consulting firm for a massive premium.
Just so they can put out a press release saying they have an AI strategy.
Exactly. They overpay for a buzzword. That would destroy the Cannibal thesis instantly. It would burn the cash and probably dilute shareholders.
It would be catastrophic. It's the classic error of a management team that doesn't understand that their own undervalued stock is the best acquisition they can make.
So the advice for anyone looking at this is monitor M&A like a hawk.
If they start buying other companies, worry. If they keep buying their own stock, sleep well.
Stick to the knitting. Eat the shares.
Couldn't agree more.
That's it for today's deep dive on Gartner. We hope this helped you unpack this massive dislocation. It's a classic battle between the fear of the future and the cold, hard math of the present.
It's going to be a fascinating story to watch play out over the next few years, a real test case.
Don't forget to like, subscribe, and check out that link for Interactive Brokers if you want to support the show. We'll see you in the next deep dive.
Stay curious, everyone.